Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Massive news today, folks. S&P Global has given Strategy a B- credit rating. This is huge. Yes, S&P Global, the same institution that once stamped AAA ratings on mortgage-backed grenades, has officially rated Strategy. The result is a B-. So for those of you who do not speak credit alphabet soup, that is junk status, the same label that they give to airlines that can't afford jet fuel and retailers that are 1/4 from liquidation. But this isn't an airline or a failing retailer. It's the world's first Bitcoin Treasury Company holding 640,000 Bitcoin, roughly $74 billion at current prices, against $8 billion in debt. And the S&P calls that risky. They are worried about high Bitcoin concentration. Translation, they are afraid of math that they cannot control. So they slap on a B-, the corporate equivalent of a scarlet letter, and pat themselves on the back for prudence. The irony is that this is the most solvent company that they have rated all year. It just happens to run on a protocol instead of a printing press. And this is where the story begins. The first time that a legacy ratings agency tried to measure a Bitcoin balance sheet and ended up grading its own ignorance instead. Now, to be clear, this is absolutely incredible news because of precedent. This is the first time a Bitcoin Treasury Company has been credit rated, and this is disproving hundreds upon hundreds and probably thousands upon thousands of the stupid haters on X who continue to doubt Michael Saylor. So before we get into it, I'm going to read a couple posts that I made on X today because they are quite hilarious when you look at what S&P Global actually said about this rating. This is straight from the horse's mouth, kids, so we're going to get into this. So this is a bit of the announcement itself. Strategy Inc. assigned a B- issuer credit rating. Outlook stable. Strategy Inc. is a Bitcoin Treasury Company that uses proceeds from the issuance of equity and debt financings to accumulate Bitcoin on its balance sheet. So they say, we view Strategy's high Bitcoin concentration, narrow business focus, weak risk-adjusted capitalization, and low US dollar liquidity as weaknesses. These are only partially offset by the company's strong access to capital markets and prudent management of its capital structure, including maintaining no maturities in the next 12 months and financing its business primarily with equity. We have assigned our B- issuer credit rating. The stable outlook reflects our expectation that Strategy will continue to prudently manage maturities of its convertible debt. So then I made this post because I looked into what they actually said, and it is hilarious. I want you guys to read this little blurb here, the thing that I circled. I want you to pause the video and read it 10 times, or just listen to me read it. It is hysterically funny. Because most of the company's assets are in Bitcoin and its Bitcoin holdings are likely to continue to grow materially, we are likely to continue to view capital as a weakness. Because the assets are in Bitcoin and its Bitcoin holdings are likely to grow, we view capital as a weakness. So basically, we are likely to continue to view capital as a weakness because their Bitcoin holdings are likely to grow materially. So basically, the more Bitcoin they buy, the weaker their capital becomes. What I'm saying is that single sentence is the most revealing thing that they have ever published about how fiat risk model collapses when confronted with non-sovereign collateral. If Strategy held US Treasuries yielding 4% instead, the S&P would probably call that high-quality capital. But no, because they're holding digital immortality that's going to appreciate at 40% a year for the next 5 to 10 years, no, that is risky. So this is the fiat system literally admitting that their capital models are tethered to fiat correlation and not actual solvency, and that is why we are so incredibly early. Why is this ridiculous? Well, I'm going to get into it. But first, before we get started, a special thank you to Horizon for sponsoring this video. If you guys didn't know, Horizon helps you tap your home equity to buy Bitcoin. There's no debt, monthly payments, or term limits. The Bitcoin is fully yours to hold however you want to with no risk of forced liquidation. I'll talk more about them at the end of the video. Link is in the description below. So the first thing that I want to do is to put a B- credit rating in context if you don't know what I'm talking about, because apparently a junk rating now covers the most solvent Bitcoin treasury on earth and JetBlue Airways, an airline airline that's currently flying on debt fumes and customer patience. And the reason why I picked JetBlue is because they were recently downgraded to the same B-. They raised over $3 billion of new debt just to stay alive, and their leverage ratio is roughly 15 times EBITDA. Their free cash flow for fiscal year 2024 was negative $2.2 billion. So translation, JetBlue borrows billions of dollars to lose money in a business that literally burns fuel for a living, and Strategy is sitting on $74 billion in Bitcoin, has no near-term maturities, and its biggest expense is electricity and accounting, yet both are equally risky. So S&P logic appears to be, if it moves and has Bitcoin, just panic. But if it bleeds cash and sells plane tickets, that's a stable outlook. This is what happens when a risk model can't distinguish from a balance sheet and a bonfire, because Strategy's biggest threat is price volatility, but JetBlue's biggest threat is physics. But sure, yeah, same rating. Okay, sounds good. Let's talk about Hertz, the rental car company that literally died 5 years ago. Hertz went bankrupt in 2020 after being crushed under a mountain of vehicle debt and a global travel shutdown. They emerged from bankruptcy, promptly re-leveraged themselves, and now carry $16.3 billion in debt obligations. Their adjusted free cash flow in 2024, a negative $1.77 billion. Their market cap, $1.6 billion. That means the market values the entire company at less than 10 cents on the dollar of its total debt. And the S&P looks at that and says B-, stable outlook. Of course, because nothing screams creditworthy like losing money renting out depreciating metal boxes in a cyclical industry with a capital structure that's held together by duct tape and denial. So remember, because Strategy has $8.2 billion in debt and an $85 billion market cap, that means that's 52 times the valuation and half of the leverage of this company, and a reserve asset that's actually appreciating over time. And just to let you know, if you guys have ever been to a Hertz before, their collateral literally drives off of the lot and loses value instantly. Have you purchased a brand new car before or seen a stupid relative do it? That is what's happening to Hertz. And Strategy's collateral is running 24/7 on a decentralized network that never calls in sick, yet they share the exact same B- rating. That's not just mispricing risk, kids. This is institutional legacy dementia. And here's a little fun fact for you. Hertz had a 2024 report that literally showed their depreciation per unit per month rising from $2 billion to $3.6 billion. They are literally losing billions because their cars are falling apart faster than they can pay for them. But somehow, that is fine. Apparently, having a fleet of rusting sedans is safer than holding a balance sheet made of Bitcoin. Hertz is another company that is a walking corpse of fiat credit, dragging $16 billion in debt across the asphalt, and Strategy is the most liquid, over-collateralized corporate treasury in history. But yet, yeah, same B- rating. And that's what happens when you measure the new financial world with a ruler designed for the old one, except this time, the ruler is broken, everyone's pretending to not notice, but the Bitcoin wizard is not pretending to not notice. This rating is not about risk, it is about something called ideological comfort. They can't downgrade their old world's view, so they downgrade Strategy instead. And this is where the tragic comedy of the entire situation becomes structural. Let's talk about how the ratings agencies actually model risk. Their framework was built decades ago to evaluate companies that sell physical products, borrow fiat, and pray that their interest coverage ratio doesn't collapse before the next refinancing window. So, their model revolves around 4 pillars, which are leverage, cash flow stability, sector diversification, and asset concentration. And Strategy breaks all 4 not because it's risky, but because it is efficient. It doesn't have sector diversification because it doesn't waste capital chasing bad industries. And it has asset concentration because it only holds the one asset that's actually solvent. Because we all know diversification is selling the winners to buy the losers. So their model just panics. It can't process a company that's solvent by design instead of by accident. Their Windows 95 spreadsheets are treating Bitcoin volatility as a red flag, not realizing that volatility doesn't equal insolvency when your liabilities are fixed and your collateral is global. The irony is that they assign higher ratings to companies that rely on constant debt rollover just to exist, and they call that operational continuity in their worlds, but in reality, that's just elegant insolvency. Strategy doesn't need to roll debt every quarter or beg for covenant waivers. Its biggest existential threat is S&P's refusal to learn how to use a calculator built after 1993. I'm picturing Dave Ramsey in a 1993 beige office chair giving this rating. These analysts are using the same formulas that they used for Hertz, JetBlue, and JCPenney. Then they're acting confused when a Bitcoin Treasury Company doesn't fit the molds. They're not measuring risk. They are measuring conformity. If a company doesn't behave like a dying airline or a bankrupt car rental firm, it gets punished. According to this model, having 640,000 Bitcoin on your balance sheet is a concentration risk, but having $16 billion in depreciating cars, well, apparently that is asset diversity. So when you see a B- slapped on strategy, you need to understand what it really means. It is not a verdict on their solvency. It is a confession that their model is obsolete. The ratings agencies are not evaluating strategy's financial structure. They are grading their own inability to evolve with the times. Quick review of the numbers again, because this is where the absurdity stops being philosophical and just becomes arithmetic. Hertz, $16.3 billion in debt, market cap $1.6 billion. That is a debt to equity ratio so bad that it should come with a health warning. They owe 10 times more than the entire company is worth. Yes, that would be like Strategy owing $700 billion of debt. And the S&P is giving them the same rating. JetBlue, 15 times debt to EBITDA, negative free cash flow, running a business that is literally setting money on fire and fuel at the same speed, also a B-. Strategy, $8.2 billion in debt, $74 billion in assets, $85 billion in market cap, positive treasury growth, same rating. You could explain this to a toddler and they would ask if S&P was okay. I thought that credit models were supposed to price default probability, but when a company with $8 billion in liabilities gets the same rating as a company with $16 billion in rotting cars, it's not a model anymore. It is an astrology chart. So, let's just run a stress test, obviously. Cut Bitcoin in half. Even at a 50% drawdown, strategy still has the asset coverage ratio. If Bitcoin went down 80%, strategy would be fine. Yes, that is how over-collateralized strategy is. I'm not exaggerating. Do the math yourself. It can pay off every dollar of debt and holds more Bitcoin than every other country in the world. Now give Hertz a 10% revenue shock. Their debt coverage collapses. They spiral into insolvency. So if you guys leave this video with one learning, I want it to be this. Listen to this sentence. In S&P's world, a company that survives an 80% Bitcoin drawdown, a collapse in its reserve asset, that deserves the same rating as a company that dies if tourists stop renting Toyotas for a weekend. That is not risk parity, that is risk parody. The math exposes it. The entire premise of junk assumes the company's solvency depends on continuous external liquidity, but strategy doesn't need that. It is structurally solvent. Its collateral base just moves every 10 minutes on the blockchain, not every fiscal quarter in a boardroom, but the model doesn't digest that kind of solvency, so it flags it as danger. It's like watching someone fail a test that they wrote themselves. This is disgusting. And the quantitative mispricing, not only with strategy, but now the other Bitcoin Treasury companies, is very obvious. It is measurable, it is public, and it is now immortalized in S&P's own database. The market is not going to forget this, because one day when these Bitcoin treasuries are rated BBB or higher, everyone's going to look back at the B- and realize it wasn't strategy that was risky, it was the model itself. So remember, I know I'm hyped up, but this is good news. Now we get to watch the climb up. Strategy has a rating. This has proved all the haters wrong. So really quick, let's talk about the word risk, okay? Because in traditional finance, risk means price movement. If something fluctuates, they call it dangerous. But if it stays flat while the currency underneath it melts, they call it stable. Which, as you know, that's not analysis, that is Stockholm Syndrome. Traditional finance is asleep to Bitcoin invading the system. Because the problem isn't that Bitcoin is volatile, the real problem is that fiat is quietly dying in slow motion, actually really fast motion, and the ratings agencies built their models to ignore that fact. The truth is very simple. Volatility is a measurement of truth discovery, and fiat hides that discovery, and Bitcoin exposes that. Strategy's balance sheet moves because it's connected to real price discovery, not because it's weak. So as we're talking about volatility, Hertz doesn't move much because the market has already priced in its own funeral. These analysts mistake movement for instability and stagnation for safety. That's how they ended up rating companies that implode overnight with investment grade. The real definition of risk is this. It is the probability of not being able to meet your obligations. Bitcoin eliminates that risk entirely by making your assets liquid, auditable, and unforgeable. Fiat creates that risk by relying on counterparty promises, opaque leverage, and a central bank that can evaporate your purchasing power before lunch. So when the S&P ever calls strategy high risk ever again because it holds Bitcoin, they are projecting. The only thing volatile here is their grasp on the future monetary reality. I'm sick of seeing these institutions confuse data with danger. They are seeing volatility and thinking risk. They are seeing solvency and think unknown. It's not that strategy is risky, kids. It's that their spreadsheets cannot handle honest numbers. Until these models start measuring actual default risk instead of emotional comfort, every Bitcoin treasury will be labeled junk, while the real junk parades around as investment grade. Risk hasn't been redefined, it's just finally being revealed. And here's the part that nobody in traditional credit wants to admit: the market has already replaced them. What Strategy and Metaplanet are starting to do is building a parallel credit system that makes their old models irrelevant. They are issuing preferred shares backed by a reserve asset that settles in real time. That means every issuance is effectively collateralized by digital liquidity and not promises on paper. This isn't leverage, it's structural recursion, using equity and debt issuance to buy more Bitcoin, which increases collateral, which increases credit capacity. Legacy finance calls this risky, but in reality, it's the most transparent form of balance sheet expansion ever created. For the love of God, go to the strategy.com homepage. They have their entire balance sheet as the first thing that you see. There's no hidden leverage anywhere. There's no opaque, ridiculous, hidden nonsense. Every preferred holder, every common equity holder, every single investor, every regulator can see the collateral 24 hours a day. A Bitcoin-backed yield curve is already forming. Each issuance creates a new duration band: short-term convertibles, medium-term preferreds, long-term equity dilution, and the collateral base grows underneath it. It is auditing credit. The legacy credit still assumes that yield comes from time and risk, and Bitcoin credit proves that yield can come from time and transparency. And you got to remember, these agencies haven't updated their templates since before half of their analysts were born. They still treat collateral as static and capital as opaque, and the Bitcoin treasuries are engineering the first dynamic on-chain credit architecture. And the reality is that they don't need the S&P's approval because the credit instruments are literally too good to ignore. The market is going to accept them. Strategy does not need S&P 500 inclusion because the market will acknowledge its superiority. And we're all living through this. We're just letting the S&P document its own obsolescence in real time, and it is glorious to witness. The joke is writing itself. The companies being called junk are the only ones whose collateral actually exists. The reason why this is good news in a nutshell is because it is an obituary for the old credit regime. The old world doesn't exist anymore. Bitcoin is now part of corporate capital markets. The ratings agencies just haven't realized it yet. One day they're going to revise their models, pretend that they saw it coming, and quietly upgrade the same companies that they're labeling junk today. Because everybody watching now is going to remember this ridiculous B- rating. Because it is the exact moment when the world's first Bitcoin Treasury Company was officially called junk by a system that's already collapsing under its own debt. The irony writes itself. Strategy didn't get downgraded, S&P did. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please subscribe to the channel and like this video to help me spread the orange gospel to the masses. I bring daily Bitcoin insights in the greatest wealth transfer in the history of humanity, and I want you on my side every step of the way. Have a terrific day. Do not party too hard. Class dismissed. Once again, a special thanks to Horizon for sponsoring this video. Most people don't realize this, but on average, 60% of American homeowners' net worth is locked up in their primary residence. And with home prices more inflated than ever, Americans now sit on a combined $35 trillion in home equity. Now there's a way to unlock that trapped capital and put it to work in Bitcoin. Horizon helps homeowners unlock a portion of their home equity to buy Bitcoin. It is not a loan, so there are no new monthly payments. You keep living in your home as usual, and then later when you sell, refinance, or choose to settle early, Horizon's provider takes an agreed share of your home's future value. That is the trade. Unlock cash now to stack Bitcoin by selling a slice of your home's future value while you continue living in it. What makes Horizon stand out is that there are no term limits and you keep 100% of the Bitcoin upside. The Bitcoin is fully yours to custody however you want, wherever you want, with no risk of forced liquidation. If you've been sitting on a pile of home equity and are eager to invest in Bitcoin, this may be the product for you. Visit joinhorizon.com to see if you qualify and get started. Their team of experts will work with you one-on-one from start to finish. Transform your dormant home equity into Bitcoin today with Horizon.